Imagine a company that seemed unstoppable during global lockdowns and virtual everything. The bicycle in the living room became a symbol of safety, status, and connection for millions of people suddenly cut off from gyms and social life. Investors poured billions of dollars into a narrative where hardware, software, and community fused into a new fitness empire. By spring of 2020, that narrative hardened into belief and valuation, and more than a few people thought Peloton would redefine how we move forever. But high tides have a way of revealing weak anchors, and the story that began with triumph would unravel into miscalculation and tragedy over the following years. This is a story about growth, hubris, and the brittle logic of pandemic winners. Before 2020, Peloton was a niche idea wrapped in premium hardware and subscription video classes, and its valuation had already attracted curious investors. The company tightly combined a stationary bike, a monthly video subscription, and a brand story promising community and convenience inside users' homes. It was an elegant product, market fit on paper for busy professionals who wanted boutique studio experiences without leaving their apartments. When the pandemic hit, the tightness of that product, market fit, suddenly became elastic as millions of people searched for alternatives to closed gyms and canceled group classes. Demand accelerated like a switch being flipped, and Peloton, S-brand, content library, and aspirational community offered a simple pandemic-proof solution for home fitness. The timing could not have been better, and the company's fortunes would change almost overnight. Lockdown created a feeding frenzy for connected fitness, and Peloton found itself at the center of that frenzy with skyrocketing orders and exploding subscriptions. People who had never paid for online classes started subscribing in droves. And the bike transformed from a luxury purchase into a pandemic imperative for many households. The subscription revenue model made Peloton feel like a recurring revenue machine, attractive to investors who value predictability during uncertain times. That feeling of predictable revenue pushed Peloton's market narrative into the realm of permanence. Yet permanence in business often depends on assumptions about the world that can flip as abruptly as government mandates. Investors were not only buying a bike, they were buying access to people locked in their homes. And the market responded by increasingly pricing future growth into today's valuation. This combination would soon produce both breathtaking numbers and dangerous expectations. By late 2020, headlines began to celebrate Peloton as the pandemic as big winner, and the market rewarded the company with a valuation approaching $50 billion. The headline number was staggering, transforming a niche fitness outfit into a public market darling overnight, and capturing the imagination of media and retail investors alike. That valuation reflected expectations of sustained membership growth, massive hardware sales, and an ability to expand into new categories without losing the core community that made the product sticky. But valuations that large often mean assumptions are doing heavy lifting, and those assumptions can be brittle when the underlying reality shifts even slightly. A $50 billion number amplifies risk because it expects not just current performance, but near magical future outcomes to justify the price. When the world began to reopen, those expectations would start to fray faster than anyone anticipated. With market validation in hand, Peloton accelerated production and expansion plans to meet demand that felt endless and unstoppable to company insiders. The board and executives doubled down on factories, logistics, and inventory, betting that growth curves would continue upward indefinitely and that the channel could absorb more units. Executives bought new manufacturing capacity, signed long-term supply deals, and planned a future with bikes in millions of homes. This investment-heavy strategy made sense under one crucial assumption: that demand would remain high even after the pandemic receded. The company treated the surge as a permanent reconfiguration of consumer behavior instead of a temporary reaction to closed gyms and social distancing. That strategic interpretation set up Peloton to own large fixed costs, inventory exposure, and a need for continually high unit sales to justify capital deployment. Beyond manufacturing, Peloton also doubled down on product diversification, promising a broader ecosystem that would deepen members' engagement and lifetime value. The company invested in content studios, new fitness categories, and a next-generation treadmill that promised to finally crack the outdoor running problem for home users. Executives pitched a future where Peloton would be more than hardware. It would be the central nervous system for at-home fitness. And investors loved that story because it created many potential revenue streams. However, diversification requires focus and flawless execution, and the treadmill project would later reveal the dangers of moving too quickly without fully appreciating operational and product risks. What looked like sensible expansion from a distance began to contain hidden hazards, and risks accumulated quietly inside a fast-moving machine. The treadmill would become a pivotal turning point in the company's trajectory. one that would reverberate across public perception and regulatory scrutiny. In late 2020 and early 2021, the company IPO, era narrative, and pandemic tailwinds combined to produce exuberant investor behavior, and the stock price soared as retail and institutional buyers chased momentum. That momentum created a feedback loop where rising prices validated the growth story and justified even more aggressive expansion plans. Management, flush with capital and confidence, continued to scale manufacturing, marketing, and R&D at a pace designed to capture the largest possible market share quickly. But financial markets can be unforgiving when narratives change, and momentum can evaporate as fast as it appeared once circumstances shift on the ground. The company had accumulated capital and commitments that were expensive to unwind, and that made Peloton more vulnerable to any reversal in demand or public trust. The fragile connection between belief and reality would soon be tested by operational failure and a changing public health landscape. Then two things happened at once. Vaccines started rolling out and governments began loosening restrictions, and exercise behavior began to normalize in ways people underestimated. Gyms reopened in many cities, boutique studios resumed classes, and people who had bought at-home solutions began reevaluating their needs. The pandemic-driven purchase decision was partially reversed as consumers regained access to outdoor fitness, social workouts, and commuting routines that previously absorbed their time. The reopening created a demand shock in the opposite direction, and Peloton's assumption of persistently high hardware sales collided with the reality of shifting consumer priorities. Where the company had expected even more subscriptions and unit sales, it instead saw slowed orders and rising churn in certain segments. The market responded almost immediately as growth expectations were revised downward, and the valuation that once seemed justified suddenly looked precarious. Amid the demand deceleration, Peloton faced an existential PR crisis when reports emerged about safety issues with its treadmill product and a tragic child death that was widely reported. The recall sparked regulatory interest, negative headlines, and a nationwide reassessment of the company's product safety practices. Families and regulators demanded answers, and Peloton's brand, carefully built on trust and community, suddenly stood exposed to intense scrutiny and public anger. The recall was not merely a product problem, it was a trust problem. And trust in consumer brands is a fragile, but crucial asset that can be destroyed faster than it can be rebuilt. Customers began questioning the company's engineering processes, quality control, and corporate transparency. And the reputational damage hit concurrently with declining demand and rising inventory problems. The timing could not have been worse for a company levered to consumer confidence and recurring subscriptions. The recall forced Peloton to halt sales and shipments of the treadmill, creating both direct costs from the recall and indirect costs from lost consumer trust and halted product lines. The company had to implement corrective actions, manage regulatory engagement, and compensate affected customers while trying to maintain subscription growth and hardware sales. Meanwhile, the narrative in the press shifted from celebration of innovation to questions about responsibility and governance at the company. Handling a safety crisis while managing an overextended production footprint is one of the most difficult combinations for any company, and Peloton found itself facing multiple operational problems simultaneously. Executives scrambled to address safety standards, communications difficulties, and an unfolding legal landscape. And those efforts drained attention and cash at a time when the business needed steady execution more than anything else. The treadmill episode accelerated the decline in confidence among customers and investors alike. As a result of slowing demand and the recall, inventory began to pile up in warehouses and distribution centers across multiple continents, and those unsold bikes became a financial anchor for the company. Pallets of boxed bikes waiting for buyers carry not only storage costs, but also depreciation, logistical friction, and marketing expense to move units through channels. The capital tied up in inventory produced a cash flow strain that undermined the company's ability to fund operations and investment simultaneously. Large inventory write-downs and the need to discount products to clear space further damaged margins and brand positioning. And the once prized premium image started to feel compromised as discounting became necessary to move hardware. An accumulation of slow-moving inventory is often a silent sign of a business losing its pulse. And for Peloton, it signaled that the market no longer validated the scale of production the company had built. The arithmetic of surplus inventory accelerated the broader financial deterioration. Financially, the company moved from showing rapid top-line growth to reporting mounting losses and rising operating expenses that no longer matched revenue expansion. Investors who had previously tolerated high burn rates because of high growth began to recalibrate their expectations and to demand clear pathways to profitability. The re-rating of the stock reflected that new reality, where future growth assumptions were pared back and capital market patience evaporated. That re-rating translated into a vicious cycle. Falling stock price made capital more expensive and harder to access, which then forced more drastic cost-cutting measures and negative headlines. The company, which had been planning for scale with an optimistic capital outlook, suddenly needed to make immediate choices about layoffs, facility closures, and inventory reductions to survive. Those choices had human costs and further signaled to the market that the company was no longer on a tranquil growth path. To stay afloat, Peloton implemented layoffs, cut discretionary spending, and scaled back production commitments. Decisions that were painful but necessary under the shifting financial constraints. These measures helped reduce cash burn but also risked weakening the product and content ecosystem that had originally attracted subscribers. Each cost-cutting action contained trade-offs between short-term survival and long-term competitiveness, and management had to balance delicate considerations under public scrutiny. What companies like Peloton face in these moments is a strategic fork in the road, retrench to survive, or continue to spend to chase regained growth at the risk of deeper losses. The choices made in that window often determine whether a company can pivot effectively or whether it becomes a cautionary tale. Peloton's decisions would influence not just its balance sheet, but also its capacity to restore trust with customers and investors. Investors ultimately voted with their money as the stock price cratered, dropping roughly 98% from its pandemic highs and erasing paper fortunes in the process. The market's punishment was both a reflection of the pullback in demand and a recalibration of the company's future cash flows in light of the treadmill recall and inventory overhang. That steep decline turned headlines into cautionary tales and triggered additional margin calls for leveraged investors who had bet on continued momentum. A 98% decline is the kind of collapse that humbles markets and founders alike because it rewrites the trajectory of expected success into a much narrower path forward. The market cap contraction turned Peloton from a $50 billion juggernaut into a company fighting to regain basic financial stability and credibility. The confidence that once buoyed the company had become fragile, and the public narrative shifted from triumph to survival almost overnight. By the time the market had finished recalibrating, Peloton's implied value hovered near $1 billion, an astonishing decline from its peak valuation that compressed expectations dramatically. This new reality reflected not just immediate financial adjustments, but also a broader skepticism about how pandemic-driven demand would persist in a post-pandemic world. A $1 billion valuation does not erase the underlying assets or the customer base, but it does force a very different calculus for future investment, product launches, and strategy. Under this new valuation framework, the company had to learn to be leaner, more disciplined, and more accountable to quarterly results and customer experience. The heavy investments in manufacturing and inventory that once seemed visionary now looked like overreach in a market returning to pre-pandemic norms. How Peloton would adapt from here depended on whether it could reconcile its community. First, branding with a sustainable financial model under tighter capital constraints. Leadership changes and governance questions followed as shareholders and the board sought answers and a credible path forward, and the company entered a period of introspection and strategic reorientation. Founders and original executives often struggle with the shift from visionary scaling to disciplined management. And Peloton faced similar cultural frictions internally. New leadership priorities included rebuilding safety protocols, streamlining operations, and refocusing on the services and content that made the brand unique. Rebuilding trust with customers and partners required transparency and tangible improvements, not just apologies and press releases, and the company committed to technical fixes, recalls, and more rigorous testing processes. Those actions were necessary but not sufficient, because a brand is also a bundle of emotional associations that take time and consistent action to repair. Peloton's ability to navigate this phase would determine if it could find a sustainable niche in a crowded fitness market. Beyond raw numbers, Peloton's collapse teaches a story about the limits of growth at all costs narratives and the perils of extrapolating temporary behavior into permanent demand. Pandemic-era successes exposed how investor psychology can inflate businesses when the future seems certain. And the reverse is true when uncertainty returns. Companies built on environmental conditions that can change rapidly need built, and resilience to survive even modest shifts in consumer behavior. In Peloton's case, the combination of over-levered manufacturing, a hazardous product recall, and a sudden reversal in consumer habits produced a confluence of negative forces that few contingency plans fully anticipated. The lesson is not that hardware businesses cannot be successful, but that capital allocation, safety governance, and realistic scenario planning matter enormously when scaling. The story also highlights how reputations can be fragile and how quickly market narratives can flip. There is also a human cost to these corporate dramatic arcs, from factory workers affected by fluctuating production to employees laid off during downturns and customers who felt betrayed by safety failures. The human stories often get lost in financial reporting, yet they reveal the broader societal consequences of rapid scaling and rapid reversal. Lives are rearranged when companies grow too quickly and shed capacity too abruptly. And that social cost is part of the fuller accounting of what happened at Peloton. Recognizing the human dimension helps us think more critically about how companies should be regulated and managed, and it frames accountability in concrete terms instead of abstract valuations. Good corporate governance includes taking seriously the welfare of employees and customers. And crises like this force conversations about corporate responsibility that extend beyond quarterly earnings. Those conversations are vital to preventing similar collapses in other industries going forward. From a product perspective, Peloton also exemplifies the tension between hardware and software businesses, where hardware requires high upfront investment, and software often scales more gracefully with lower marginal costs. The initial hope was that hardware would serve as a durable acquisition channel for high-margin subscription services. But when hardware sales slowed, the economics of the whole business shifted unfavorably. Managing that duality requires precise forecasting and flexibility to shift capital toward the more resilient parts of the business when conditions change. Peloton's experience underscores the importance of not tying too much of a company's future to one product category, especially one with complex manufacturing and warranty obligations. Sustainable business models often rely on diverse, resilient revenue streams and the ability to pivot quickly when one channel falters. In a post-pandemic world, the balance between experiential value and scalable software economics remains a central strategic question for consumer tech companies. Looking forward, Peloton's path is not predetermined, and the company still has assets that matter, including a dedicated user base, proprietary content, and brand recognition in a crowded fitness market. If leadership can stabilize operations, repair trust, and focus on profitable membership growth rather than excessive hardware milestones, there is a plausible recovery story. The shift will require hard choices about capital allocation and honest communication with stakeholders about realistic growth trajectories. Rebuilding will take time and steady execution, and the company must demonstrate that it learned from past mistakes through permanent process improvements and customer-first policies. Recovery does not mean returning to a mythical $50 billion valuation overnight, but it could mean creating a sustainable business that delivers value to members and returns to investors in a measured way. The market rewards credible plans and consistent delivery, and Peloton's future will depend on its ability to offer both. The Peloton story also becomes a larger cautionary tale about pandemic-era capitalism and how quickly narratives can swing from utopian to dystopian when external conditions shift. Investors and founders both learned how fragile some business models are when they rely on extraordinary, short-term trends to justify massive capital deployments. The structural lesson is that resilience, cautious capital deployment, and rigorous safety practices are not optional. They are essential for durable companies in any industry. This broader perspective invites reflection about how we value companies and how we incentivize growth. And it suggests the need for more conservative scenario planning when environmental assumptions are as uncertain as during a global pandemic. The Peloton collapse may prompt other companies to rethink their risk posture and to place greater emphasis on sustainable margins over headline-grabbing expansion. Those changes would be a practical response to the painful lessons of 2020 and 2021. Philosophically, the arc from pandemic darling to struggling company forces us to confront how much of our economic story is built on fleeting human behaviors and how much on durable preferences. Companies that thrive over decades do so by understanding both short-term shifts and long-term human needs, adapting without losing their core purpose. Peloton's rapid ascent and subsequent decline remind us that early success is not destiny, and that humility is a practical requirement for sustainable leadership. Ultimately, the Peloton saga is a mirror for an era defined by enormous shocks and fast capital flows. And it asks whether markets and managers have learned to be more disciplined about assumptions and more humane in execution. The company's future remains uncertain, but the lessons it leaves behind will likely influence business thinking for years. If we pay attention, those lessons can lead to better governance, better products, and fewer heartbreaking collapses. In the end, this story is both specific to Peloton and universal to business cycles, showing how winners can become losers when environment, governance, and execution misalign. The company that reached a $50 billion valuation learned the hard way that scale without prudence can be a dangerous illusion. The fall to an implied $1 billion valuation is dramatic, but it also resets expectations and opens the possibility of a new, more sustainable chapter if the right lessons are learned. If this tale gives one takeaway, it is that durable companies are built on a combination of realistic forecasting, strong product safety, prudent capital allocation, and a commitment to human stakeholders, the Peloton episode will be studied in business schools and executive suites as an example of both the heights possible in a disrupted market and the cliff that lies beyond unchecked assumptions. For founders and investors alike, it is a cautionary story worth remembering. If this video gave you a new perspective on the Peloton story and the forces that shape modern startups, then you're not alone in wanting clearer answers and better accountability. Stories like these matter because they teach tangible lessons about how to build companies that survive both the highs and lows of business cycles. If you found this analysis useful, consider subscribing to keep exploring the hidden dynamics behind company collapses and big economic shifts. Thanks for watching. And if this gave you a new perspective on how fragile success can be, hit subscribe for more videos that unpack the stories behind modern business and innovation. We will continue to follow Peloton's journey and similar cases, because the next lesson is always just around the corner and worth understanding before it happens again.